Okay, get ready because we're about to go deep on this. Warner Bros. Discovery's Q3 2024 financial report.
Oh, yeah.
You sent this over, and wow, it's a lot to unpack. But I
No,
think there are some real gems in here.
absolutely. It's much more than just like what happened in the quarter. It really gives you a sense of the forces reshaping the entire media landscape, really.
Yeah, yeah. So let's start with the big picture, right?
Yeah.
WBD, they reported a net loss for both the quarter and the first 9 months of 2024.
Yep, they did. And a $135 million loss for the quarter, and for the 9 months, a lot bigger, $10.8 billion. But remember that massive $9.1 billion impairment charge?
Oh, yeah, yeah, we're gonna get to that.
Yeah.
That's a big number.
Right, and it's really important to understand what that means. Basically, what an impairment charge means is that a company has decided that an asset on its books, in this case, it's their network's reporting unit, is worth less than what they initially thought. It's kind of like when you realize your house has gone down in value because the neighborhood isn't as desirable as it used to be.
So it's a hit to their balance sheet, but they didn't just lose $9.1 billion in cash right now.
Exactly. It's what's called a non-cash charge. But it does signal that WBD is acknowledging some serious challenges in the traditional TV network business.
Which makes sense when we look at the revenue breakdown. Distribution revenue is down, especially from domestic linear, so cable subscribers. Cord cutting is still happening.
Oh, absolutely. And they lost another 9% of their domestic linear subscribers to
Mm.
compared to last year. So, it's a stark reminder that the cable TV model is really struggling.
And as those viewers go away, well, so does the advertising revenue. That whole market for linear networks, it seems to be shrinking.
Yeah, it's like watching a domino effect. Fewer people watching cable channels means that advertisers are less willing to spend those big bucks to reach them. They're going after those viewers on streaming platforms and digital spaces, really, where they're spending their time.
Now let's get to I think the more interesting part, content revenue. It's kind of mixed, I'd say. So on the one hand, there's a huge drop in theatrical revenue compared to Q3 2023.
Oh, remember Barbie?
Oh, yeah.
Yeah, broke all kinds of records last year. Well, WBD is now experiencing I guess, the hangover from that success. It's a classic example of how relying too much on a single hit can really create these swings in your financials.
Yeah, yeah. Like the next album after you have a hit album is always going to sell less.
Right.
So, does this mean WBD needs to think about like a more consistent stream of hits, rather than just banking on these occasional blockbusters?
Yeah, that's the million-dollar question. I mean, this report really highlights the risks of putting all your eggs in one basket, especially in the world of entertainment, which can be unpredictable.
And it's not just the movies either. Their games revenue is also down. And they specifically mentioned the success of Hogwarts Legacy last year, which, that's a tough act to follow.
It is, yeah. The Hogwarts legacy effect is definitely fading, and it raises a crucial question for WBD. Can they create consistent gaming hits? Things that really capture the zeitgeist, or are they too dependent on these big franchise titles?
Maybe they should look at the indie game scene.
Maybe.
That's where a lot of the innovation comes from, and there's surprising successes there. But at least there's one good thing happening within the content revenue. TV licensing revenue actually went up. What's going on with that?
Yeah, so it seems like they're finding, creative ways to make money off their content beyond just the traditional releases. They've specifically mentioned that they're sublicensing Olympic sports rights in Europe as a big part of that increase.
So it's a reminder that even in this rapidly changing media world, you can still find these opportunities, right? Ways to make money off valuable content and reach audiences on different platforms.
Absolutely. This is where WBD's diverse portfolio of assets really starts to work for them,
Mm.
because it's not just about these blockbuster movies and hit video games. It's about finding ways to make money off existing content, reaching audiences in different ways.
That makes sense. So we've talked about how WBD is doing with some, serious challenges in their, we'll call them their legacy businesses, but they're also looking at new ways to make money. Now let's talk about that big thing everybody's talking about, that $9.1 billion impairment charge. So what can you tell us about what led to them having to, so drastically reassess their network reporting unit?
Yeah, well, remember those declining cable subscribers and the shrinking ad revenue?
Yeah.
Yeah, those are big warning signs, but there's more to it than that.
Okay, yeah. This is where it gets interesting. Fill us in. What else is WBD worried about when it comes to their networks?
Well, imagine you're trying to predict how much money a TV network is going to make in the future. That's essentially what WBD did. They used what's called a discounted cash flow model, and it's basically like a financial crystal ball that helps them estimate the present value of future cash flows.
Got it. Okay, so what are they seeing in this crystal ball that's got them so nervous?
Well, they're facing a kind of perfect storm of uncertainty. So not only are people ditching cable like crazy, but the future of those lucrative sports rights deals, those are up in the air. The report specifically mentions the NBA as a concern for them. And renewing those deals, they're expensive. And with the media landscape changing, it's getting harder and harder to justify these huge payouts.
So they're looking into the future and they're just seeing a lot of question marks. Cord cutting, advertising revenue going down, and the cost of sports rights going way up. No wonder they had to, no wonder they had to write down the value of that unit.
Yeah, yeah. It's definitely a reality check for a company that was built on the back of these networks, but it's also a sign that they're, recognizing that they need to adapt to this new world, the world of streaming.
Speaking of streaming, let's talk about their direct-to-consumer segment, or DTC, which is, I'd say, maybe the only bright spot in this whole report. They're seeing subscriber growth and revenue growth there, right?
That's right. That's where they're really putting their hopes for the future. The international launch of Max has been huge for them in terms of getting new subscribers. They're reaching beyond U.S. borders, tapping into this global audience that wants streaming content.
So they're getting the subscribers, but are they making money from it yet? I mean, streaming, it's so expensive, especially when you think about all the content they have to create and all the marketing.
Yeah, it's a tough balancing act.
Yeah.
They need to keep investing a ton of money in content to attract and keep those subscribers, but they also have to find a way to make it profitable.
It's a high-stakes game, and the next few quarters will be really interesting to watch. We'll see how they balance their investments in streaming with, keeping their debt under control and maybe even figuring out how to, revitalize some of those struggling businesses.
Yeah, this is where it gets really, really interesting.
Well, we've got more to talk about. We'll be right back to dive deeper into those restructuring charges, how they're managing their debt, and some other, interesting stuff that's hiding in this report. Stick with us.
So, before the break, we were talking about how WBD is kind of in this balancing act. They're investing a lot in streaming while, their traditional TV networks are struggling.
Yeah, those restructuring charges we saw, those are pretty interesting.
Right.
They're lower than last year, which is good, but
No.
still, it just reminds you that merging two huge companies like Warner Media and Discovery,
Yeah.
that's a big, it's a big, complicated thing.
It is. It's like blending two families, each with their own traditions, their own, habits, even their favorite snacks.
Yeah. And the report, it says that the integration after the merger, that's mostly done, but these charges show it's still going on a little.
Right.
And it's not just about merging offices and staff, it's about figuring out what content works in this new combined company.
Yeah.
We talked about the games a bit earlier, and there's a line in the financials that caught my eye. Impairments. Pretty big ones, actually. What's that all about?
Well, this is where we get a glimpse into their content strategy, really. Because these impairments, what they suggest is that some of the games they've put out, they haven't quite lived up to expectations. They've invested a lot of money in developing and marketing these games, and now they're basically saying, well, some of them aren't making as much money as we'd hoped.
It makes you wonder which games, right? I mean, were they just too ambitious with some of their projects? Did they get the market wrong? Or maybe they put a lot of money into a genre that's not as popular as it used to be.
Right, exactly. It's a good reminder that even these big entertainment companies, they make mistakes. And in the gaming world, things move fast. Trends change so quickly.
Yeah.
And those mistakes, they can be costly.
They can be, but I guess for every game that, for every flop, there's the possibility of a huge hit, right?
Absolutely. That's how it goes.
It's the business. Okay, let's finally talk about that big number we keep bringing up, that $9.1 billion impairment charge. We've talked about what's causing it, cord cutting, ad revenue going down, and, uncertainty about sports rights. But I think it would be good for our listeners to really understand what that charge actually means for WBD's, for their finances.
Sure. Let's break it down. So WBD has to look at the value of their assets all the time, right? And one of those common ways to do this is through something called a discounted cash flow analysis, or DCF.
Yeah.
So imagine you're trying to figure out how much your house is worth today, but you also take into account how much rent you could get from it over the next few years.
Right.
A DCF model, it does something similar for a business like WBD's networks. It's looking ahead and trying to project future cash flows based on all kinds of assumptions like
Mm.
revenue growth, expenses, and interest rates.
So WBD ran this model, this DCF model, for their networks. And basically, the results were not good. They had to say, okay, this segment is worth a lot less than we thought it was a year ago. And that difference, that's the $9.1 billion.
That's it. Exactly. It's a
Yeah.
non-cash charge, but it's a pretty clear signal that the market is, it's losing faith in those traditional TV networks. And that's not just a WBD problem. It's happening across the whole industry.
But, while those networks are struggling, their direct consumer, or DTC, that part of their business, that looks pretty good. We talked earlier about how launching Max internationally is getting them more subscribers, but there's something else in the report that I found interesting. How their ad light tier in the US is performing.
Oh, yeah, that's interesting. Yeah. It's all about offering choices,
Mm.
and it seems like people are really responding to that. It's a
Mm.
smart strategy because everyone's so worried about the cost of things these days. You've got so many streaming services out there. Everyone's trying to be the cheapest.
It's like the streaming wars are becoming a battle of who can offer the best deal, right?
Exactly, exactly. But if you make it cheap, you still have to bring in enough money to pay for all that content.
Oh, absolutely.
Yeah.
And it's not just the content, it's all the marketing you have to do just to get people to sign up for your service in the first place.
Right, right.
Speaking of things that make it hard to cut through the noise, we can't ignore the WGA and SAG-AFTRA strikes, right? They had a big impact on WBD and really the whole entertainment industry.
Oh, yeah, for sure.
I mean, they even mentioned it in the report, talking about how the strikes have affected their bottom line.
Yeah, those strikes have, really shaken things up in Hollywood. Production schedules are messed up, releases are delayed, and there's just this sense of uncertainty that's really hard to measure.
Yeah. It reminds you that even a big company like WBD, they're not immune to things they can't control, right?
Absolutely.
But honestly, the strikes, they're just one piece of a much bigger puzzle. I mean, WBD, like every other big studio, they're trying to figure out this big change in how people consume entertainment.
Yeah, it's a fascinating time to be watching this industry. And this report, it really gives you a glimpse into the challenges, but also the opportunities. But beyond the big trends, there are some really interesting details in here, things that tell you how WBD actually operates.
Okay, I love these little details. What did you find?
Well, one thing that stood out to me was their use of derivatives to manage currency and interest rate risk.
Derivatives, huh?
Yeah, they're pretty complex, but think of them like insurance policies that protect WBD from losing money if currencies fluctuate, or if interest rates go up and down.
So they've got a whole team of financial experts working behind the scenes, making sure they're protected from the global economy going crazy.
Exactly, exactly. And it reminds you that running a global media company, it's not just about making great movies and shows.
Yeah.
It's also about managing risk.
And speaking of risk, they have a lot of debt, right? We touched on this earlier. But the report, it shows that they're actively trying to manage it. They're refinancing and making repayments.
Yeah, they're definitely walking a tightrope. They got to keep their lenders happy.
Yeah.
But they also have to invest in areas where they can grow, like streaming.
Yeah. And then there's the fact that their credit rating outlook was downgraded recently. That's that's not a good sign. It means those credit rating agencies are worried they might not be able to manage all that debt.
Yeah, it's like a warning light on their dashboard.
Yeah.
They needed to take care of that quickly.
So let's see. They've got declining revenues in their traditional businesses. They're putting tons of money into streaming. They've got a mountain of debt. And now their credit rating is being questioned. That's a lot to handle.
It is. It is. But, even with all that, you can see a sense of, determination in this report. They're not hiding from the problems. They're trying new things, looking for ways to grow.
So even when things are disrupted, there's still a chance to reinvent yourself, right?
Absolutely. Absolutely.
Yeah.
There always is.
Okay, we've covered a lot here, but I think the most important question is, what does all this mean for, for our listeners? Why should they care about what's happening with WBD? What's the big takeaway here?
That's a good question. I think the big takeaway is that WBD, they're like a microcosm of the whole media industry.
Okay.
They're dealing with the same challenges and trying to answer the same questions as everyone else.
So they're a case study in how to, how to deal with this changing world where the old rules don't really apply anymore. Right?
Exactly. Exactly. And the decisions they make over the next few, months, years, they're going to have ripple effects throughout the whole industry. It's going to affect what you and I get to watch and enjoy.
Okay, we're back after a quick break. We're going to dive into the final part of this deep dive.
Here.
Get ready for some some big questions and some predictions about what the future holds for WBD and for the whole media world. Stay tuned. Okay, so we're back and ready to wrap up our deep dive into Warner Bros. Discovery's Q3 2024 financials. We've gone over a lot, everything from those declining cable subscribers to the rise of streaming and, of course, that huge impairment charge and the Hollywood strikes. But now I want to shift our focus to you, our listener.
Yeah, absolutely.
We've looked at the numbers, we've explored the trends, we've analyzed the decisions WBD is making. But the real question is, what can you take away from all this? How can you use these insights to better understand, what's happening in the media landscape?
That's the key. Right.
So let's get practical for a minute. If you were the CEO of WBD, what would you be doing differently? What would your big move be?
Ooh, that's a tough one. It's easy to sit back and critique from the outside.
Yeah.
But WBD is facing some really complex challenges, and there are no easy answers. They're trying to please Wall Street, keep up with what consumers want, and figure out all this new technology all at the same time.
It's like they're trying to steer a huge ship through a storm while also trying to, rebuild the engine, right?
Exactly.
So given all that, what would your priorities be?
Well, I think the first thing would be figuring out how to move faster towards streaming while also managing, the decline of those traditional businesses. They can't hold on to the past, but they can't just abandon those old revenue streams overnight.
It's that balancing act again.
It is.
They need to, squeeze every last dollar out of those old businesses while also investing heavily in streaming, which is, that's the future.
Right. And that means making some tough choices, how much to spend on content, how to market themselves, and maybe even selling off some parts of the company that aren't doing so well.
It's like cleaning out your house to make room for new furniture.
Yeah. Get rid of the old stuff.
You got to make space for the things you'll enjoy in the future.
And speaking of enjoying things, I think another priority for WBD has got to be finding that spark again. you know, that passion for their brands. Remind people why they loved Warner Bros. Movies and HBO shows and CNN News in the first place.
They need that magic back. Yeah, that sense of wonder that made those brands so big. Exactly, and that might mean taking risks, trying new things, and maybe even, bringing back some of those classic franchises in new and exciting ways.
Like House of the Dragon on HBO Max.
Oh, yeah.
They used the popularity of Game of Thrones, but made something new and exciting.
Exactly. It shows that even in a world that's always looking for the next big thing, people still love stories that connect to our shared history.
Absolutely.
And that brings us back to you, our listener. Think about how you watch things. Have you cut the cord? Are you subscribing to more streaming services? Are you drawn to familiar things, or are you always looking for something new?
Because your choices, what you prefer, what you're willing to spend money on, all of that is shaping the future of media.
And companies like WBD, they're watching closely. They're trying to guess what you'll want to watch in 5 years, in 10 years.
It's a fascinating back and forth, between what consumers want and what these companies are trying to do.
Yeah.
And as we've seen in this deep dive, it's getting harder and harder to predict.
It is. So as you're watching your favorite shows, playing your favorite games, scrolling through, all those streaming services, remember that you're not just watching, you're actually helping to shape the future of entertainment.
That's a pretty powerful thought.
It is. And with that, we're going to wrap up this episode of The Deep Dive. We hope you found it insightful and engaging and maybe even a little inspiring.
And until next time, keep exploring, keep asking questions, and keep diving deep.
Thanks for listening.